All right, let's talk about the economy. Every day we get hit with a flood of headlines and news reports that can feel like they're in a totally different language. In this explainer, we're going to break down the biggest terms you always hear and hopefully turn those confusing headlines into concepts that actually make sense.
You hear these words thrown around all the time, right? GDP is up, inflation is down, recession fears are looming, and it can all sound pretty intimidating and, frankly, a little stressful. But these things aren't just abstract ideas. They have a real impact on our jobs, our savings, our whole future. So what are these big economic indicators really telling us? Let's dive in and find out. Okay, I want you to think of the entire economy like a patient showing up for a checkup. To figure out how healthy it is, the doctor needs to check its vital signs. Well, for an economy, the single most important vital sign, the first thing we always look at, is something called GDP.
So what exactly is it? Gross domestic product, or GDP for short, is really the broadest, most complete measure of a country's economic activity. You can think of it as the grand total price tag for every single thing a country produces and sells over a set time, usually a quarter or a full year.
Now, what's really cool is how we actually calculate this giant number. There are two ways to do it, and they're really just two sides of the very same coin. We can add up all the money everyone's spent on stuff, that's the expenditure approach, or we can add up all the income everyone earned from making and selling all that stuff, that's the income approach. And here's the logic. Since every single dollar you spend ends up in someone else's pocket as income, both methods should give you the exact same number. Pretty neat, right?
But there's a really important catch. If prices go up, inflation, it could look like our GDP is growing even if we aren't actually producing any more stuff. That's what we call nominal GDP. To get the real story, economists use real GDP, which cleverly strips out the effects of changing prices. So this is absolutely key. Whenever you hear the news talking about economic growth, they are almost always talking about the change in real GDP, because that's what tells us if we're actually making more things, not just if things are getting more expensive.
Okay, so if GDP is the economy's pulse, what actually makes that pulse beat faster or slower? Well, it all boils down to this fundamental tug-of-war between two massive forces, what everyone wants to buy and what all the businesses are able to sell. Let's start with the buying side. This is what economists call aggregate demand. And don't let the fancy name fool you. It's not about one person wanting to buy a new phone. It's the total combined demand for everything in the entire economy, from cars to haircuts to the government building a new bridge. It really just represents the total spending power in the whole system. And all of that spending power comes from four main sources, which you could think of as the four engines driving the economy. First, you've got consumption. That's all of us, regular households buying things. Then there's investment. That's businesses spending on new equipment and buildings. Then government spending on things like roads and schools. And finally, net exports. That's just our total exports minus our total imports. Basically, the balance of what we sell to the world versus what we buy from it.
So that covers the want-to-buy side. Now let's flip to the other side of that tug-of-war, aggregate supply. This is the total amount of goods and services that all the businesses in the country, combined, are willing and able to produce. It's basically the economy's entire productive capacity.
Now, here's where things get interesting. Supply acts differently depending on the timeline. In the short run, if prices go up, companies can ramp up production because some of their biggest costs, like worker salaries, don't adjust right away. Economists call those costs sticky. Think about it. Your salary is probably set for a whole year, right? It's sticky. But in the long run, everything eventually adjusts. Wages catch up, contracts get renegotiated, and at that point, the economy's supply isn't determined by prices anymore, but by its fundamental potential, its technology, its workforce, all the deep stuff. So we've got this delicate balance, this equilibrium between demand and supply. But what happens when something comes along and just knocks it all out of whack? Well, that's when we get the economic booms and busts we hear so much about. Economists call these disturbances shocks. So let's look at the demand side first. What on earth could happen that would suddenly make everybody, households, businesses, everyone, want to buy way more or way less, even if prices haven't really changed? Well, it's anything that messes with one of those four engines of spending we just talked about. And here are some of the biggest culprits. If the stock market is booming, people feel wealthier and they spend more. If some bad news hits and everyone suddenly gets pessimistic about the future, they start saving instead of spending. And of course, the government can have a huge impact by changing taxes or adjusting interest rates, which makes it cheaper or more expensive to borrow and spend money.
So let's just walk through a classic scenario. Imagine a wave of bad news sweeps the country, maybe about global events, and people get really worried about losing their jobs. Consumer confidence just falls off a cliff. What happens next?
Well, people start clutching their wallets. They put off buying a new car, they cancel that vacation. Our big consumption engine just sputters and slows down. The total demand in the economy shrinks. The result is that our real GDP, our total economic output, falls. This is exactly how a sudden drop in confidence, a negative demand shock, can trigger an economic slowdown or even a recession. But wait, shocks don't only come from the demand side, from the buyers. Sometimes the shock hits the economy's fundamental ability to produce things. And the main reason for this? A sudden, unexpected change in how much it costs for businesses all across the country to make their products. And what could change those costs? Well, a huge one is the price of key ingredients, like oil or steel. But it could also be a major technological breakthrough that makes everyone more productive. Or it could be a sudden change in business taxes. Anything really that makes it cheaper or more expensive for firms to operate. So let's use a classic example of a negative supply shock that everyone can relate to. A sudden, sharp spike in the price of oil. Since energy is a critical input for almost every single business, from airlines to farms to factories, a shock like this hits the entire system. Because it's suddenly way more expensive to produce and ship everything, businesses have to cut back. The total supply in the economy shrinks. And this leads to a really painful, nasty situation. The economy slows down, GDP goes down, but at the same time, the price level actually goes up. That toxic combination of a stagnant economy and high inflation has a special name: stagflation. It's the worst of both worlds. Whew. Okay, so we've seen how these shocks can come from either side and knock the entire economy off balance. Now, we can use these tools to officially diagnose one of the most common economic ailments you hear about all the time: a recession. Let's go back to our patient analogy. When a big negative shock hits, the economy's actual output, its performance, falls below what it's truly capable of at full health. Economists call that difference a recessionary gap. The economy is basically underperforming. It's like a patient running a fever, not operating at 100%. And what does this gap actually feel like in the real world? It's not just a concept on a chart. It means real people lose their jobs. It means companies aren't earning as much profit, so they stop investing and stop hiring. These are the tangible, often painful consequences of an economy operating below its full potential. And this quote really just sums it all up perfectly. The ups and downs we hear about in the news, what they call the business cycle, it's really just the visible result of these shocks constantly pushing our real GDP up and down around its long-term potential. It's the ongoing story of the economy getting knocked off balance and then slowly, sometimes painfully, trying to find its way back. So we have all these powerful tools to understand what's happening. We can see the causes, we can diagnose the effects. And all of this leads to the biggest, most important question of all. If we've gotten so good at diagnosing the illness, can we ever find a permanent cure? Can we make the economy healthy for good? Well, that's the debate that continues to drive economics and policymaking to this very day.